Hi everyone, and thanks for joining us today. I was just waiting for a few more people to pop on this webinar. Welcome Vicky. Welcome Karen. Got a few coming on now. This one's got a little bit of interest to it, so with superannuation. Thanks Liz for joining us today. Hi.
Hi, no worries.
Okay, hi everyone. My name's Susan Wilkin and I'm the President of AAVIP, Australian Association of Virtual Industry Professionals, and we're trying to bring to you a voice of industry understanding, especially in these times of change and these times of unprecedented events at the moment as well. So today we have Liz Haile on the call from Haile Financial Services. Liz is presenting to us about the early release of superannuation and basically what we need to know surrounding that and what we want to gather from that. So Liz is an experienced financial planner and was recognised as one of the top emerging 20 finalists in Australia. So we're very pleased to have Liz with us today. And Liz is somebody that I've actually known in business and personally for, 15 years, Liz?
Oh, yeah.
Maybe we don't show our age. Maybe we just say 10, okay?
Works for me.
Sounds good. So Liz, thank you so much. I'm going to hand this over to you to start your presentation and tell us all about superannuation, how we can access it, if we want to access it, do we want to access it? Now, guys, just a couple of housekeeping things. There is a chat below that if you click on all panelists and attendees, everybody will be able to get to see your question. So just pop that in there for us, and every few bits of information that Liz shares with us, we're going to stop and answer any questions that you have. There's also a Q&A tab as well that I've actually got highlighted to the bottom of your screen, and you can actually ask questions in there as well. So Liz, I'll let you share your screen and fire away, and I'll also pop a copy to the link of Liz's screen in here as well for you guys.
Okay, thanks Susan. All right, give me a second. I'll work out how to share the screen and see how we go. Okay, so fingers crossed you guys can see all that now.
We can, yep.
Excellent. Okay, so this is an article that I put together a week or two ago when all of this was released. So it's really just the basics of what you need to know, some of the things that the ATO will be looking for from you if you do go ahead with this, and I can probably give you a little bit of guidance around some of the time frames as well. So this article is available on my website, so feel free to go and have a look later on. Now, so ordinarily, as most of you will know, it's quite tricky to get your money out of superannuation early. You need to be not very well or dead, essentially. So not easy to get your money out. So what the government's trying to do with this is alleviate some of the social costs of having to do this and get us to pay for some of our own. So the first thing to know is if you do this, you are taking this money from your retirement funds. So you're essentially taking a little loan out on your retirement balance. So the government has what we call conditions of release. And so what they've done is created a new one called Covid-19 early release of super. And this is now legislated. The applications to do it opened on Monday this week. So it is now live and you can go ahead and do it. Okay, so what are the rules and are you eligible? So the rules are you can now access up to $10,000 of your superannuation in this financial year and a further $10,000 in the next financial year. So the financial year runs from 1st of July to the 30th of June, which means that you can access up to $10,000 before the 30th of June. And then after the 30th of June, you can apply for a further $10,000 if that's what you need. Important thing to know there is that the applications are open now, but you can apply any time between now and the end of June for that first round. So there's not necessarily a huge rush to do that today. If you are unsure of whether you need it, you've got time to make those decisions. So the eligibility. For Australian citizens and permanent residents of Australia, there's 3 criteria. So you need to be either unemployed, you need to be eligible to receive or receiving job seeker payments, parenting payments, or some other kind of pension from Centrelink. Or after the 1st of January 2020, you were made redundant, your working hours reduced by 20% or more. If you're a sole trader and your business was suspended, you need to be able to show a reduction in turnover of 20% or more. Most people should be able to, if you're eligible on one of those criteria, justify that relatively easily. In terms of the evidence and what the ATO will be looking for, they've actually come out and said that you do not need to attach evidence to support your application. So at this stage, given the time frames and that sort of stuff, they're telling us that we don't need to provide any proof. So obviously that leaves this a little bit open to people applying when they're perhaps not necessarily eligible or a bit borderline. They are suggesting, however, that you should keep your records. So there are penalties for making false and misleading statements. So if you do this and you're not quite eligible and you get audited, expect some hefty penalties. Having said that, you don't have to attach evidence. So it alleviates the paperwork burden at this point.
Liz, just a quick question on that.
Sure.
The eligibility criteria, do you need to be all 3 or just one of those?
Just one of those criteria. There are some different criteria if you are temporary residents. I haven't put any of that on here. If you're on student visas and some of those sorts of things, there's other criteria, and I can provide links if we need it. But for the vast majority of people, it's going to be one of those 3.
Okay, that's great. Great, thank you.
That's all right, no problem. Okay, so the next bit is, how do I apply? So there really is only one way to apply. The media are telling you can do it through MyGov or ATO. You can go to the ATO website if you like. That's just going to direct you to MyGov. So you need to have a MyGov account and you need to have the ATO linked to that account. It's relatively easy once you get in there. You just follow your nose. The buttons are large and obviously placed. So they're trying to make it as easy as they can. You register your interest if you've already done that, but you can actually do the applications, as I said, from Monday this week. So it is live now. Once you have applied and it's being processed, we haven't had any indications yet from the ATO on what the processing timeframes are. But once it has been processed, you will receive a letter of approval. So you will receive that into your MyGov inbox, or a rejection letter if that's the case for you. But you will receive that into your MyGov inbox. That will usually prompt a notification to come to your normal email to let you know that there's a letter waiting there. But if you're not seeing anything like that, perhaps pop in and have another look and see if you've heard anything back from that. What's not in this article that we found out quite recently is that the ATO are indicating timeframes to the superannuation providers for processing these requests. And at this stage, they are saying that they are expecting those to be processed within 5 days by the super fund once it's been approved. So as with all things government, we can expect it not to be overly efficient and speedy. So by the time the ATO has approved it and then notified your superannuation provider that they've approved it, it's then a further 5 days and you should be getting cash released into your bank accounts. Those timeframes are all indicative. The super funds may or may not be able to adhere to those. Some of them are having some issues around liquidity at this stage, but the vast majority should be fine and sent through to your bank accounts. But any questions on that at that point is probably best taken to your superannuation provider after it's been approved. But there's no point ringing your super provider until you've got that level of approval from the ATO, because they can't do anything for you anyway. Any questions on that?
Not on that, but in your list above, you've got job seeker, but is JobKeeper also included in that list?
No, it's not.
No, it's not? Okay, but
No.
if you're eligible for any of those, then pretty much, yeah.
Yeah. So if you're on JobKeeper, but your working hours haven't been reduced, and so essentially you're just keeping on going the same thing. So in a scenario where your employer has lost turnover, but they are using that JobKeeper money to keep paying you and you haven't had any reduction in working hours, then you're not eligible for accessing money from your super. So, but if you are on JobKeeper and your hours have been reduced, so if you've gone from 5 days to 3, for example, then yes, you're eligible for it on that basis.
What about self-employed, or you were a sole trader? Yeah, okay.
Yeah. So if your business has been suspended or there's a reduction in turnover of 20% or more. So it's important to note too that that's not profit, that's turnover. So if your sales have reduced, I mean, the easy numbers are if you've gone from making 100,000 in the year to 80, then you're eligible, 80 or less. All right.
Great. Thank you.
That's okay. All right. Now, so what do you do if you don't have a MyGov account? The easy answer is you get a MyGov account. Sorry, but it's the only way to get access to this. So you go to the MyGov website. It's relatively straightforward. There are lots and lots of instructions available online on how to do it. I've got a link here in the article that will help you if you need it. It's the instructions on how to do that. The important bit is to link the ATO to your MyGov account if you haven't already. You'll need to have 2 forms of paperwork that have been sent to you by the ATO and will have some kind of a reference number on it. So if you're a notice of assessment on a previous tax return, for example, will have a notice number on it. And so if you've got some of those, then you'll be able to identify yourself online and connect that account into your MyGov. All right. So what do you do if you're not eligible for this? So there are a number of other conditions of release. So you could look at something like severe financial hardship or compassionate grounds. They are quite strict in their rules, but they are available if you need it. In most cases, if you're eligible for either of those, you would probably be eligible for the COVID-19 release as well. There is potential for some people to apply on both grounds if they want to and try for more money. They're up to the trustee of the trust, which is the superannuation provider, to decide whether they'll approve those or not, whether they're within the rules. If you want more information on those, there's a link here on the article that will take you to all the other early release of super conditions that are available. So they include things like total and permanent disability and terminal medical conditions. Okay, in terms of professional advice, so I'm not able to give professional advice in this kind of a medium. Everything that we discussed today is general advice. And as per all the usual warnings you'll hear, please take into account your own personal circumstances before doing or acting on anything. There are consequences to withdrawing funds from your superannuation account. The most obvious one, obviously, is a reduction in your superannuation balance. So that will be both now and into the future. So the other part of doing that now is that you are actually you're selling your superannuation when the assets are cheaper than they were before. So it's a bigger hit to your superannuation balance than it would have been if you had been able to take that money out back in January when markets were quite a bit higher. So, because as a percentage of your balance, it will be more. So when markets do rebound, which they will, they always do, if you've taken the money out, you've got less in there to grow and provide for your retirement. So that's the main consequence. Some of the other things people might forget about is things like the insurance in there. So if you have a lower balance in your superannuation and that account is being used to fund your insurance, then you need to be really careful what you do here. So that's where you may want to talk to your superannuation provider before you do anything. So you need to make sure most of the super funds will have a minimum balance that you have to have in order to be eligible for that insurance. So you need to make sure you're not going to be going below that. And then you need to make sure that there's going to be enough money in there to pay the premiums and other things like that. So it's definitely worth double checking all of that before you do anything. If you do lose your insurance, it can be tricky to get it back. So they will make you go through an underwriting process to get that insurance back. And if you have had occupational changes, or as lots of us have, or if you have had medical issues, you may end up with the higher premiums or exclusions and not being able to get cover in some cases. So definitely look at that before you do anything. Now, we did have somebody ask before the webinar around taking this money out and whether to do that and put it on your mortgage and what the difference would be there. So if we've got a minute, Susan, I'll just go through that really quickly.
Yes, definitely.
Okay, great. So in terms of what you should do, that's not a question that I can answer. As I said, in this kind of forum, I don't know enough about the individual circumstances to work out which one is in your best interest. So you need to take into account things like your age and how long you have to make this difference back up into your superannuation fund, what the relative balances are on your super and your mortgage, etc., what sort of difference that will make. What are the goals do you have? How close are you to retirement? Are you likely to be achieving those objectives anyway? The person who asked the question also suggested that their superannuation wasn't making any good returns at the moment. So first of all, we need to have a definition of what is a good return. And that again is different for everybody, because some people are happy with high risk investments and others aren't. So, but even your average sort of stock standard balanced fund should have been making, as an average over the last 10 years or so, an 8% return on average. If it's not doing anything like that and is below a 6 at least, then you really need to be having a look at the super fund itself and working out why that's the case. There could be a number of reasons for that. It could be high fees, although that's unlikely. Industry funds like to talk to us about high fees all the time, but the vast majority of super funds are all around the same, including the industry funds. But it could be the investments, as I said, that you've got. So whether they are conservative investments or aggressive investments or a mix, that could be why it's not doing what you want. The other thing to have a look at is the insurance premiums, because they come out of your superannuation balance as well. And that can often be what's having the biggest impact on your balance. The investments may well be performing quite well, but if you're not contributing a lot of money and you've got insurance premiums coming out, that's often the main reason I see why super funds are not, or people think their super fund isn't performing properly. So I'll just flick over here to this compound interest calculator. And again, this website, moneysmart.gov.au, is a fantastic website for anything financial. So it's put together by ASIC, which is the Australian Securities Investments Commission. So they're the body that look after financial advisors, amongst others, and punish us when we do the wrong things and set the rules and all that sort of stuff. So they put this website together and they're responsible for all the content on it. So most of what you see on here is pretty reliable. Now this compound interest calculator. So what we can do is do a really quick calculation on the impact of having 10,000 in your super versus having it on your mortgage, and do a quick comparison as to what might be better. And as I said before, this is purely on a numbers basis. And so everybody's circumstances are different, and you may have other considerations outside of the actual, just the financial impact. But if we do, we'll just do the 10,000 to start with. And so if we take $10,000 and we say, okay, if my super fund was going to, we're not going to put any regular deposits in because we're just looking at the impact of this one number. Compound frequency, monthly or annual, not a huge amount. If we look at this over, say, 10 years, and the average super fund, if it was making 8%, okay, so the loss to your super fund of not having that $10,000 in there over the course of 10 years is $21,589. So that's what it's costing you in 10 years' time of having this money now out instead of in your super. If you are in your 30s and looking at retirement in your 60s, you could plug this in for 30 years. And that $10,000 that you take out now is taking $100,000 off your retirement balance at the end of retirement. So everybody can put in their own timeframes and all those sorts of things in here. Now, if we flip that around and say, okay, well, what would it make in my mortgage? What is it going to save me? We say, okay, we'll say the same amount of $10,000. The regular deposit is a 0. Compound frequency, we'll change that to monthly because your mortgage will compound monthly. Actually, for the comparison, we'll leave it the same. It's fine. Go back to the 10 years, and remember that was $21,000 that was going to cost us. Let's be generous and use a mortgage rate of 3.5% at the moment. Most people, if you're applying for a new mortgage and if you haven't reviewed it lately, they are starting with a 2 at the moment. So definitely worthwhile looking at that. That's another point, but anyway. So this one at 3.5, if you put that money into your mortgage and left that in there over the 10 years, it would save you $14,000. So on a purely numbers basis, it's looking like it's better to leave it in your superannuation. That depends on your circumstances. If you need the money, you need the money, and that just is what it is. If we extrapolate this out over the 30 years, like we did before, where it was going to, you would make $100,000 if it was left in your super, it would only save you 28. Over the longer term, it's far better left in the superannuation than in a mortgage on that basis. I hope that helps and answers the question. There are other considerations, obviously, than just the numbers, but the numbers don't lie. Okay.
Okie dokie. I like it.
That's all right.
Any other questions, everyone? Teresa said to say thank you so much too, by the way. Yes, that's perfect.
No dramas at all. I hope it helped.
Yeah.
If you're in any doubt, see a professional, and yeah, they should be able to stop you doing anything too wrong anyway.
Liz, that compound interest calculator, would you mind sending it through to me, and I can actually get it out to everybody on the webinar as well? I'm sure everybody would be interested in having a play with that one, right?
Yeah, absolutely. It's a really good one to show your children, that one. I really like it because they are so young. Well, mine are anyway. My oldest is 16. So showing him the value now of putting a little bit into his savings now, and what that might look like for him when he's older is fabulous. So while he's young and looking like getting his first job, I'm actively encouraging him to put some extra money in his superannuation now so that he doesn't have to when he's my age, because it's already there and earning what he needs while he's being fed by me.
It's that 5-year and that 40-year plan, right?
Yeah, absolutely.
Definitely. Look, it doesn't look like we've got any other burning questions. Oh, hang on. So many teens are using Afterpay. So this is a great distractor. Yes. It is. The
Afterpay is
and
so
Uber
dangerous.
Eats, and Uber Eats, the amount of times you just jump on and go, right, I'm getting food delivered. I've heard so many times.
Oh, and my son is guilty of this as well. And we had a discussion about it just last week when we worked out that he had spent $100 in 2 weeks on food, which is provided to him free by me at the moment. So, yeah, he was a little horrified that he'd actually spent that much. He hadn't realised it was that much. And Afterpay is even worse because the fees on it, if you don't make the payments, are horrendous. They're like credit cards on steroids, really. They don't have the same backing as the banks and some stuff like that. It's not teaching children great habits. I'm a big fan of trying to teach them early that if you can't afford it, you can't have it, and save up and get it. As soon as you've purchased it, the joy is gone, but that debt will be with you for a while.
Yeah, it reminds me of the, what was those cards that you used to get, and they were the interest-free for 18 months or whatnot. But
the GE credit lines and those.
that's the one, which were great, especially when we were younger. But we still had to pay the $15, $20 fee each month on top of our our thing as well. So yeah.
Yeah, you've always got to read the fine print. So just because something says it's interest free doesn't mean it's free.
It doesn't mean
It just means it's interest free.
Exactly. And the interest on top of that at the end of that 6 or 18 months or whatever it is just extravagant.
Yeah, they're expensive if you get them wrong.
Teresa's just saying, Afterpay is terrible. My son is still paying me back after I bailed him out, so he didn't get sent to debt collection. Yeah, I'm glad.
It's really,
has he learned his lesson is the question.
If you can try and encourage them for their online shopping, if they can have what do you call it, debit cards instead of credit cards.
Yeah,
that's the way to go, and just spend their own money.
Exactly. Yep, definitely. No, it is a good lesson to learn. Teresa said, yeah, I think so. Time will tell. I think with all of them, time will tell.
Oh, I see plenty of people in their 40s who still haven't learned that lesson, so and beyond. So
yes, it's easy done, especially when you get in the cycle of buying. I think now's a really good time that we're all sort of sitting back and we're going, you know what, we don't need to buy that. We're not going anywhere. We're not doing anything. We're just having some time of just not.
Yeah, well, I think I'm probably like everybody else. I'm sure everyone else has noticed it. What I'm spending on my weekly discretionary spending is greatly reduced from what it was. A bottle of wine a week at home instead of going out for dinner or going out and buying a new top because I'm going out for dinner or any of that stuff. It's all stopped. So it's, saving money.
Yeah, I totally
Silver linings. You've got to find them where you can.
I know, and look, you guys, we're all in the same boat here. Look, I myself, I've got reduced work. My husband's got reduced work, but at the same time, what we're sort of saving, I can't suggest it's meeting said reduced work, but it's pretty done. You know, we're getting there, and we've got a bit of a plan, thanks to having some things in place prior and stuff like that, which was a lucky endeavour, but. To get us through this time, just as long as it doesn't last too long, right, Liz?
Oh, absolutely. Fingers crossed. We're starting to see the government easing restrictions now, so hopefully we're on the slippery slope down out of it rather than that steep climb in. So
hopefully, I saw that today. Actually, I was just talking to Liz beforehand that remedial massage therapists have been lifted. So that's one that's been lifted just today actually, but it's not for the relaxation side, it's for the actual what do you call it, the actual
medical
health side. Medical side of things. So I'm sitting there going, I'm sure that's medical.
You've got a medical issue for sure.
it's definitely medical. So I think that's about it. We haven't got any other questions here, but you guys, I'll pop Liz's website in the chat here. I'll pop it in again for you. Have a look at that article. Make sure that you actually sign up to Liz's newsletter as well, because Liz actually sends through some really great advice, especially during these times of unprecedented events. We really need that advice and that information coming through at these times. So make sure you sign up for that to grab, to get what information that you can. I promise she's not spammy at all.
No. There's another article up there relating to COVID-19 and life insurance. So if you've got any questions around your life insurance and that sort of stuff, that information's on there as well. So any questions on it, just shoot me an email. I'm at home at the moment, so happy to answer them.
I know, aren't we all? It's fabulous. Well, to a point. All right, you guys, I think that's about a wrap. If you have any questions, feel free to send them through to myself or Liz. We'll keep an eye on this. I'll actually pop this replay up on YouTube as well, so you'll have access to it. And of course, we'll see you next webinar. I'm sure there'll be another one very soon with all of these changes.
See you guys. All the best with it.
Thanks again, Liz.
Bye.